Why lower interest rates will be a boom for self-directed IRA investors. Hey everyone, Adam Bergman here, tax attorney and founder of IRA Financial, and welcome to another episode of Adam Talks. On today's episode, we are going to start seeing lower interest rates. So what does that mean as a self-directed IRA investor? So this podcast is going to explain why it actually is going to be a strong positive for self-directed IRA investors. And here are a couple factors to explain why. But before I do that, let me just give a brief history of where we are on an interest rate environment. So obviously from COVID, since March 2020, interest rates essentially went from zero all the way up until before September 18th, over 5%. And starting September 18, 2024, the Fed lowered the benchmark interest rate by half a percentage point, 50 basis points, which was the largest reduction in interest rates since COVID. And it's only the third time really since the 90s where interest rates dropped in one sitting for 50 basis points, other than 9/11, 2007, and COVID. This was the fourth time. So pretty massive drop. I'm not sure if it was merited. I don't think our economy's in such a dire strait that it was like right in front of COVID or 9/11 or during the financial crisis of 07. But nevertheless, this is where we are. And the expectation from bond traders is that the Fed is going to keep cutting rates, maybe the end of 24 and through 25 and 26. So we are going to be back, not in a zero interest rate environment, but a lower interest rate environment than we were in 22 and 23. So what does that mean for alternative assets? Well, the first thing is let the good times continue to ride, because we're going to see increased asset values. If you're investing in alternative assets, lower interest rates are going to be a boom to non-traditional investments like real estate or private company investments. Why? When borrowing's cheaper, more money circulating in the economy, cheaper to get deals done, whether it's real estate, whether it's buying private investments, which is good for someone investing in private placements or private equity or venture capital. Trickle-down effect, more money is streaming into the economy because lower interest rates is stimulating, more demand and more investment into the economy. So you're going to see prices being pushed up, especially into alternative assets. The flip side for equities, generally when interest rates are lowered, people leave the stock market, definitely leave fixed income, and they're going to go looking for higher returns, because at 5-6%, it's okay to keep your money in a money market. At 3.5%, not good enough. So you're going to start looking for returns. You may go to tech stocks, or you also may go to alternative assets like real estate or private placements, private equity, venture capital, cryptos, gold. And that's why non-traditional assets generally boom in a lower interest rate environment. Also, you get greater access to diversified assets, right? There's more of an incentive to look to diversify when there's a lower interest rate environment. It makes sense, right? When in the last year, people were parking their cash in a money market, and I get it. Makes sense, right? At 5%, 5.1%, pretty good rate of return, no risk. You're in treasuries, you can sleep at night. Pretty good. It's above inflation, whether inflation's 2.5%, 3%, getting 5.1%, safe, pretty good. But as rates drop, once you're in the threes, low fours, it's just not going to be good enough. People are going to need to chase returns, and that's where they're going to go look into alternative assets. So it's going to force you to diversify. You're going to have to get some of that money out of money markets. You're going to have to start looking for returns, which is great for self-directed IRA investors. Another great reason why lower interest rates are going to be such a value to self-directed investors is a greater compounding growth, right? With lower interest rates, alternative assets like real estate will benefit from higher cash flow and asset appreciation. So you're going to experience higher compounding return growth. Since the returns in all your IRA are tax-free, you're going to be able to take advantage of the power of compounding returns in a far more significant way by being led into alternative assets because of lower interest rates. So you're going to be forced to diversify. You're going to be forced to benefit from compounding returns. You're going to benefit from higher cash flow and asset appreciation. So all that compounding is going to increase. As you have more cash, you're going to also have higher values on your asset, which hopefully will create larger churn and larger growth when you start compounding the return. So that's why lower interest rates and compounded returns, really is a strong reason why folks tend to flow into self-directed IRAs and alternative assets. And also the last thing, of course, financing, right? It always comes down to financing, whether you're financing a business acquisition or a real estate deal. When money's cheap, more deals happen and the values are better, right? A buyer may push to get a deal done, even though the value may be somewhat higher than they want to pay. But if the financing is low and they run the numbers, then it makes sense, even if the value is stronger or at a higher value than they expect or really want to pay, because their cost of capital is so low, it makes sense. And we saw that during COVID, where people were pushing up values of homes and businesses, startups, and it didn't really matter because money was so cheap, right? We were literally at a zero interest rate environment. We're not there yet. Hopefully, we don't ever get there. I don't think that's great for the economy. It's obviously a major source of the inflation we were experiencing, which, again, for the record, don't think is finished. For the record, if I was Chair Powell putting away politics, I would not have reduced interest rates. I probably would have waited till next year. I think the economy is not as strong as it was obviously in COVID, but I still think it's pretty strong. The labor market historically, and I did a podcast about this, it's still way under average labor unemployment rates of mid sixes. We're in the fours. So yeah, it's softer than it was during COVID, but I mean, of course, that was there's $3-4 trillion pumped into the economy in a year. Of course, there's going to be tons and tons of demand, and there was not enough supply in the labor market. Now it's a little bit better, but I still think the economy is pretty solid. Consumer spending is strong, so I would not have reduced interest rates, but no, I'm not the Fed chair. So better financing options. We're going to see values are going to start to increase for private equity, for venture capital, for these startups, for good businesses. They're going to be able to go back in the market and attract more suitors because cash will be cheaper and the cost of capital will be lower. Now, in an IRA, if you go buy real estate and want to finance it, you can do it, but it has to be a non-recourse loan. That's a loan you do not personally guarantee. And it also could trigger what's called UBIT, unrelated business income tax, which is a tax on a percentage of the leverage used, which is kind of like a penalty for using leverage in a retirement account. Really no good reason for it. It follows the rules for charities, even though IRAs don't have an exempt status. And well, they don't have an exempt purpose. They have tax exempt status, but a charity has an exempt purpose, right? Like a hospital is there to care for the sick. And IRAs doesn't have an exempt purpose other than to generate retirement wealth for its beneficiaries and owner. Nevertheless, it got saddled with the UBIT tax, but there's no workaround. If you are self-employed, you have a small business with no full-time employees other than the owners, their spouses, you can set up a solo K versus an IRA and go out and get non-recourse financing and pay zero UBIT tax. So lower interest rates makes financing cheaper, whether you're using personal funds, an IRA, just make sure it's non-recourse. Beware of UBIT. But if somehow you're self-employed, you have a small business, it could be a side gig. You could have a full-time job as an executive of Apple, but on the side you do consulting, or you have a real estate management company or a realtor, whatever it is, anything that generates self-employment income, you can use that business to set up the solo K, use that as the vehicle to go out and get a non-recourse loan, buy real estate, and not pay any of the UBIT tax and shelter all the appreciation from taxation. So financing is going to help everyone. Lower capital costs will increase real estate deals, increase real estate values, increase income stream to the asset, and maybe get us back to inflation. I truly think, and this is a pretty, I guess unique perspective, but I think the Fed's going to have to raise interest rates again. I don't know when, but I think what's going to happen is they're going to trigger inflation again because people are still spending. Lower interest rates, you're going to start seeing real estate prices go up, keep going up, deals getting done, private businesses, assets appreciating, and we're going to be back into the inflation period we were, because I don't think they actually tamed it. I don't think they really put out the flames. I think the fire is still burning and they're just not seeing the smoke. So I hope I'm wrong, but I am worried about inflation. I think inflation is very difficult to really put water on and really put out without a lot of patience. And I don't think we've taken the amount of time we needed to. But the good news is lower interest rates means more opportunities for alternative assets, higher valuations, higher asset cash flow, more opportunities to make money in alternative assets. And I think we're going to see that in the self-directed IRA world. So I've already had clients just in the last week, reach out to me and say, hey, I've put my IRA account on hold. I'm back now. The deal I wanted to do, it's back on. The partners I had are going forward now, lower interest rates, financing a little bit cheaper, and we'll want to get this deal done. So I think as rates keep going down, you're going to see more of a segue back into the high flying economy we saw back in 21, 22. Will it create and trigger more inflation? That's to be seen. I hope not, but not sure about that. But as I mentioned, for self-directed IRA investors, it's the boom is going to come back as lower interest rates are definitely very, very, very good news for alternative asset investors. So that's it for today's podcast. Hope you enjoyed it. Really appreciate you guys hanging out with me today. If you have a question, comment, leave them. Love to hear from all of you. And I hope to see everyone again next week on another Adam Talks. Take care and have a great day.